So here I am making a video for you guys on a Sunday. Don't say I don't do anything for you. So a little extra video for you this week, and today I'm going to talk about the stocks I'm buying February 2024 edition. So this is the most popular video series I do on the YouTube channel, and this is where I go through the stocks that I've been buying from the 1st of January to the 1st of February. And I've done this series for many years on the YouTube channel, so there's that transparency that you guys know what I've bought, what I've sold, and I don't hide anything here. I don't have a public account, a private account. Everything that I own is on these videos. I don't sell anything quietly out in the background and go, oh, that didn't work out, I hope nobody notices. If I've bought anything or if I've sold anything, they're always on these videos, so you guys can track how my portfolio is doing. So yeah, hope you enjoy the video as always, and I'll do my UK one in a few days time, but this is my US one, and yeah, we'll get started. And as always, if you do want to support the channel, join the Patreon, £5 a month, join through the link in the description. That's where I post my live buy and sell alerts, as well as 2 exclusive videos a week, and there's a Discord with 500 members on to talk to about stocks, including me, which isn't bad at all for £5 a month. And as well as that, if you want some free shares, join Trading 2 and 2 with the link in the description. Now, first of all, Etsy. I did sell my Etsy shares. I have made a video on this, but I'll quickly, even if I made a video on it, I will put it in this video so you guys know about it. I did sell my shares in Etsy. Not really been holding this one long, just a lot changed in the few months that I did hold the shares. So I did buy Etsy in this dip here. The stock ran up a lot since me buying, and I went, that's a bit of a crazy jump. And for me, I didn't want to buy Etsy at these levels. For me, I wanted to get Etsy in like the $50 range. So it was just way too high where I wanted to buy, and I just didn't have the position that I wanted to have. So from that point of view, that was one reason why I sold, is that I didn't have the position I wanted, and it was just so far away from me buying more shares in it. Now since then, it has had a bit of a drop off, and it has actually in this last week had a bit of a bounce, but there's also a few other things that changed with Etsy during this time frame. So what came out is they laid off some more workers. Now for me, looking at Q4, which is normally Etsy's busiest period, you do not want to see Etsy come out and laying off workers on the 13th of December. That gave me worrying signs that the Q4 was a little bit weaker than what was expected. So I didn't like that, the suggestion of a week 4 coming up. And when I look at analysts have the biggest data out there. And if you look at the recent quarter, or the upcoming quarter that's happening in Q4, they've actually been downgrading the guidance, and also in 2024, the downgrades have been coming in as well. Now EPS is still going to increase, but that's probably because of the cuts. That's not going to be sustainable if they're not growing. And if you guys on the Patreon obviously saw my valuation for this, for me to get a good return, a 20% return a year on Etsy, because that's what I want a 20% return a year when I'm buying into a stock. When I was doing the numbers on Etsy, to get that return, I needed double-digit growth. And obviously at the moment, we've had a poor year this year, but we were hoping for a rebound next year, and at the moment it's actually forecast to go lower, which isn't great that the analysts are predicting that one. So yeah, with the news of the job cuts, which seem to suggest to me a weak Q4 incoming, analyst downgrades coming in, and also the share price jump just being a lot quicker than what I thought it would, and I made nearly what I was expecting in a year in basically 2 or 3 months. I decided to sell the position. I wouldn't mind buying Etsy, but probably now my price target would be lower. So previously I said I would like it under 60. I think realistically, if I was to be a buyer of Etsy now, I'd probably be looking at $40 or $50, which is where I'd probably buy. So I could buy again, but my price target's probably gone lower now to accommodate the lower growth that's being suggested. So yeah, I did sell that one for a little bit of a profit. Now getting on to the buy-in. So the first one is PayPal. No surprise here. I normally buy PayPal once a month when I'm doing these videos. And same again, I did buy once again in January. I've not bought yet during February, but I probably will buy again in February at some point. I don't know when, but the stock, obviously, even last year was a stock that performed pretty poorly when you look at last year's performance. And in fact, when we got to October time, we actually hit our 52 close of $50. And this was during a time frame when a lot of stocks decided to start rolling up in 2023. So PayPal doing totally the opposite. Now, since the new CEO, Alex Chris, has come in, which I think is a very good appointment, the stock has started going up, but it's still, in my opinion, relatively cheap, or very cheap actually, where the share price currently is. Now, PayPal is a fintech platform. Fintech platforms are definitely not loved at the moment. They're one of the areas which haven't rallied at all. But the big thing that happened is during 2021, there was a lot of demand pull forward because of all the online boom. Since then, it's had a very high valuation. It was definitely overvalued, and it's had a big valuation pullback since that time frame. And it now seems to go to in my opinion, a good valuation. But the big thing is it's just gone lower and lower and lower. And like when you look on a share price point of view, we're back at $62. I mean, to get to the point of view where PayPal was $62 again, you're going to have to go all the way to September 2017. So you're going back nearly 7 years since when PayPal were these sort of levels. They did do a big innovation day, was it last week or the week before? I've got to say it wasn't the big presentation I was hoping for. I think it was only about 17 minutes long and there was no Q&A session, but there was promising things on there. It definitely wasn't shock the world, as Alex Chris did say, but I like the direction they're going in. And the big thing with Alex Chris as the new CEO, and this is the big thing with PayPal, it's a mega company. Like, they've just got to utilize the users they have and get more money and be more cost efficient. And this company will do well. And the thing with PayPal is that we're not talking about a Meta. Meta was a stock like PayPal where it got stuck, absolutely killed on the share price. But Meta, if you look at their financials, they were so poor. The profitability was down huge. There were declining revenues. During this time frame where PayPal has had a suffering share price like Meta, the financials haven't deteriorated. That's the big thing with PayPal. Like, if you look at the financials, this year they're still forecast to grow 7%. I can name you a lot of companies that wish they could grow 7% a year. And next year they're actually expected to go to 8% revenue growth. And when you look at EPS, to $4.95, and next year it's forecast to go to $5.48. So these financials here are not poor at all. A lot of companies wish they could grow 7% and 8% a year. A lot of companies wish they could grow at EPS at these sort of levels. So the company's financially performing absolutely amazing. You look at the growth of the company, it's still very good. You look at the free cash flow, still very good. The profitability, still very good. Fantastic balance sheet. So we're not talking about a dying company here. Sometimes I think people talk about PayPal like it's a dying company, like the financials need a big turnaround. The financials are already very good. The only thing that we're wanting to see now is Alex Chris comes in and then maybe drags the revenue growth up another 1-2%. If they can drag the EPS growth up another 2-3%. That's what we're looking for Alex Chris to do, which when you look at it from that point of view, it's not really that hard of a job, especially when you've already got all them transactions going through your platform. So the company's already in a very good place, and you got a company here that's buying back $5 billion in buybacks. That's absolutely insane. $5 billion in buybacks when you're a company that's valued at $67 billion. It's absolutely crazy. And we're not talking about a company at a crazy valuation either, which is the other thing. You'd think about, well, is the company at an average valuation? Is this wanting to go to a premium valuation? Is this where your return is when you buy the company? And it's not. I mean, the company's trading at 11 times forward earnings. A PayPal that I think has 25% of the world's transactions at 11 times earnings, that's going to be a great balance sheet, buying back $5 billion back of shares, 6% growth this year. Oh, sorry, that's X's there. 7% this year and 8% the year after. With this EP, it's just crazy. Like, Alex Chris, it would be great if he does put the company even in a better position. But even right now, it's a very good valuation for the growth, in my opinion, which is why I'm willing to buy it up a lot more, or quite heavy at the moment. So InMode, I did buy some more InMode as well. This stock has been absolutely killed. It don't feel like the stock has been down 34% in the last year, but it has done. The stock has rallied up a little bit through the start of this year though, but I did buy some more InMode. They are a company that does non-invasive technology for appearances or cosmetics. So they make all these devices like Morpheus, for example, and you see a before and after photo of the device. And this is great for people who are more conscious about their appearance. They don't want to go under the knife, so they can go get this done with some of the technology that InMode do. Now, the problem is that InMode get their sales from selling the devices like Morpheus to the doctors. Now, obviously, the big thing that we've had at the moment is the higher interest rate environment. So a lot of doctors have not been willing to pay up the big money for this equipment in higher interest rate environments. The interest rates on these things or the technology products they have been crazy. InMode has been trying to manage that, also trying to bring financing in-house. So this high interest rate environment has affected them. But I think when the high interest rate environment goes, there'll be a company that does very well once again. And even in this environment, when you look at how other big expensive products have been hit, the numbers that they've actually been pulling out are still pretty impressive. And since I bought, they actually brought out their preliminary earnings, and same again, it was good to see them back in the right direction on the preliminary earnings. The stock actually went up on the preliminary earnings, and good guidance. And when you look at the company itself, I mean, even though the company is struggling for growth at the moment because of the high interest rate environment, even if the stock or the financials flatline here, it's still pretty impressive. You know, they're still doing a lot of revenue. They're still doing a lot of profitability. You could be a company that doesn't grow profitability or revenue at all at the moment, and if you're throwing off 200 million in profitability when you're a 2 billion market cap, it's not bad at all. It's not bad at all. You've got a lot of cash there. Great, absolutely amazing balance sheet, which there's no debt on there. They sit on a lot of cash, and they'll probably use that cash at some point to buy another company. Now, I personally think they should be buying back shares, but they said they're not going to do that. They're going to be buying another company. So even if the company flatlines here, when you're doing numbers like this, it's insane profit margins, and you've got a lot of choices to do with that profitability. And like I said, 11 times earnings. Imagine when we get out of this higher interest rate environment, what financials this company is going to start doing. It's going to be very impressive. Next one is dLocal. So I did do a full video on this. With this stocks I'm buying, because there's quite a few stocks on the list, I always try to keep it around to 3 or 4 minutes of stock. So if you do want a bit more information on dLocal, then go check out the full video that I did. But they are a bit of a mid-sized company at 4 billion, 36 times earnings. This is a company that I'm keeping more of a mid-sized position because there is a bit more risk with it, but the upside I think is very interesting on it. I get a lot of Mercado Libre vibes from this stock. They are a local payment company or payment processing company to connect global enterprises and businesses to emerging markets. So let's say someone like Nike, for example, which is a dLocal partner, they want to have payments from the likes of emerging markets like Africa, Asia, Latin America, which most of their revenue does come from Latin America. If Nike want to sell something in Latin America, dLocal handle that. They handle the risk, the fraud management. They then convert it into dollars for Nike, obviously reporting on a dollar basis. So they handle all that part of it. So there's a big moat here where you've got by the way, you can see all the companies that use dLocal here. It's definitely not a poor amount of customers, or the brands that are selecting to use dLocal are big clients. I mean, Amazon alone, I think, do 2 years of DD before selecting a payment provider. So dLocal, the fact that dLocal is that payment provider after Amazon did that 2 year of research shows you there's some moat around the switching costs and research here. And also dLocal as a business, if they're chosen by Amazon and Uber and Spotify and Google and Microsoft and Tencent and Shein, it's an impressive list to have. So they also handle a lot of payments, which obviously is a lot different from Mercado Libre. Obviously they do payments and also e-commerce. With payments you also have the higher profit margin as well, and we have big growing markets as well in these emerging markets. So dLocal is set to do very well for many years going forward. And as well as that, obviously I'm a Mercado Libre shareholder, which has been a very good performing stock for me. But what also I like about dLocal is that the former CFO has now actually gone to the CEO of dLocal. That's really impressive. The fact that he's willing to go, you know what, I could stay at this very good company in Latin America, or I could step up to that next level and become the CEO, is a big sign that he's seeing a big market here for dLocal to do well in the next few years. And the thing as well is, like, the financials are insane. You look at the EPS, they've gone from 0.35 up to 0.55. Really good increase on the EPS. This year they're going to grow 52%. Next year they're going to go from 0.55 in EPS up to 0.74. 37% sales growth as well next year. Crazy amounts of growth. But yet you look at the valuation of this company and it's trading at 19 times forward earnings. I think that's where the risk to reward is that there's definitely a lot of reward buying at this growth and this valuation. Now there is a few risks here which I did cover on the full video, so if you do want to go see the full video for a few more of the risks here, and that's probably why the stock is looking a little bit cheap at the moment, but I think there is good reward at the moment. And as you can see here, great growth, and you see the profitability they're throwing off, because fintech, payments, high profit margin, especially when you're taking the rate that dLocal are, because you're assuming a little bit more risk than, say, operating in the US than what some of these companies like Nike are normally used to as well. Very good balance sheet as well, as you can see here, no debt on there, and obviously throwing off great amounts of profitability. And the next stock is Fiverr. So I have been buying some shares into Fiverr. This is kind of some of the new blood you're starting to see coming into my portfolio. So when you see the local, Fiverr, and in fact the next two stocks are actually new blood into the portfolio. So these are kind of my 2023, 2024 picks for the stock market. So if I have a good next 3 or 5 years, it will be coming from these stocks, which is the key thing. So hopefully they do well. Fiverr is a freelance platform. Freelance obviously boomed in 2021. Now had a bit of a cooling off phase as a lot of that demand's been pulled forward. But now I think all the tough comps are out of the way and it will go back into a good place. Obviously online freelance work, very popular for businesses. They don't want to employ someone full time. As well as that, people are wanting to select the work they can do, what work they take on, how much they charge. So the freelance space is a good space for companies and also people that want to work in their own hours. So big growing TAM that you've got here. Fiverr itself has really started to turn around the financials now. Revenue has gone back to very good amounts of growth. The profitability is starting to ramp up as well. And this isn't being driven by sales and marketing. So we've got a company that's driving up the revenue and the profitability again, which is great. They trade at 13 times forward earnings, which is also very impressive. So when I look at the freelance growth in the next few years or the gig economy, when I look at the tough comps have been taken out by Fiverr now, and then the financials have rapidly improved as well. I'm liking Fiverr when I can pick this up at 13 times forward earnings. SoFi. So I did buy some SoFi before earnings. I'm not going to lie. I'm going to let you in a bit of a secret here. I'm probably going to buy some SoFi once again. I know I said that I'd like it in the $6 range, but I've got to say, for the sake of $1, I just go, I've got to buy some more shares because this company, in my opinion, is just totally getting crushed by shorts at the moment. The big banks at the moment, it's unfairly being put down at $7. Realistically, we should see the stock above $10 now, and it's not. So I keep thinking, you know what? If you're going to keep giving me these shares at these top valuations, I'm going to pick up some shares. SoFi, it's a fintech platform that operates online, a bank that is online only. They also have a great product. They are appealing to the younger generation. They also offer convenient products all in one space, all great products with good prices as well. You can see here they offer personal loans, invest, banking, student loans, which is still to come back, credit cards, mortgage loans, insurance, travel, student refinancing, once again, soon to come back as well. So this is just disrupting the bank space as it is a lot convenient and lower fees and all in one place for the younger generation coming through. And the big banks are struggling to adapt to this. And SoFi is taking big market share from the banks. And when you look at the recent earnings were absolutely fantastic. They swung to profitability, the growth was still very good, and the guidance as well was very impressive. And they've got new members joining so fast at the moment. And the big thing is that SoFi keep offering more and more products, more and more members, more and more products. You're cross-selling. It's going to look very good for SoFi. Now, the big banks are running scared because of how much SoFi are taking market share. I don't know why this paywall has just come up, which is a little bit annoying. But you've got companies like Morgan Stanley or banks like Morgan Stanley that are pushing the price target down lower because they are upset SoFi taking market share. And the only way that they can affect SoFi now is by controlling the market share the share price because they've got the big money. But sooner rather than later, if SoFi keeps doing these financials, it is going to get rewarded on the share price. And I think the valuation is not too bad at all at the moment. And if you look at what analysts are forecasting, analysts are actually forecasting it to go from a loss of 0.36 up to 0.06. It's going to beat that. Analysts are forecasting 16% revenue growth. If you look at the recent numbers that SoFi just put out, they're even going to be above that. So there's a lot of analysts catch up on the financials they're going to do as well. And like I said, for the valuation you're picking up at, I think it's pretty impressive. Last one is Evolution AB. So I did buy some shares in Evolution AB. Now, some of you guys might not know what this company does. Basically, they create games for iGaming. So if you go onto a site, and they actually have some of the customers further down here, if I scroll down, so AAA, Betfair, DraftKings, William Hill. So if you go onto the site, they've got a lot of the games on there. DraftKings don't actually make those games. They've got a lot on the plate already with the odds and managing everything like that. So if they wanted to have the games on the website, what they do is they go to someone like an Evolution. Evolution create these games for them, or like live casinos, and obviously they just take a cut of the money that comes through. Evolution is a kind of picks and shovels play into the iGaming space, and obviously, as you guys know of iGaming, massive growing space at the moment. And in fact, when you look at the recent financials, you got a company here that's growing 23%, the EBITDA increased 25%, major amounts of profitability, also paying a dividend, and also doing a lot of share buybacks at the moment. And as well as that, they're very diverse. They're not a company that just operates in the US, even though the iGaming opportunity in the US is huge. Most of the revenues actually come from the mature market of Europe. Asia as well is a fast growing space that you can see here, which is forecast to overtake Europe actually next year. North America is still in its very early days as well, and Latin America is actually talked about as being one of the biggest market opportunities out there. So you've got all these sectors that they operate in. I actually had a comment the other day on YouTube saying, why are you buying another gambling stock? And I was like, well, I only own one in my US portfolio, which is DraftKings. So if you class Evolution as a gambling stock, which I don't really class it as a bit of a technology stock, I think it's fine to have DraftKings because that's a direct player and they operate in North America. Whereas Evolution is a provider and also operates worldwide. So, I mean, if you call a lot 2 stocks in a 25 stock portfolio, I mean, you can do that, but I think this is a very well diverse play to add into the portfolio. And like I said, the company itself is doing really well, really good growth. Like I said, the profitability they're throwing off is really good. I mean, when you're throwing off this profitability, it gives you that option for the dividend and the share buyback that they are doing. And like I said, as you would expect, financial health wise, very good balance sheet, a lot of cash on there that they can utilize for them share buybacks and the dividend. And realistically, 22 times earnings for this company, I think is very fair for when you look at the growth and the profitability they're throwing off at the moment. And as well as that, you're collecting a 2% dividend a year, which is sure to be hiked up as well going forward. So yeah, those are stocks that I've been buying and selling in the month of February. Like I said, I'll do my UK version probably next week. So keep an eye out for you guys that are interested in my UK stocks. But apart from that, hope you enjoyed it. Let me know what stocks you've been buying as well recently. Always like to hear from you guys. And apart from that, hit that like button and I'll see you in a bit.